The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the grand poobah of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard.
What's going on? Happy Saturday.
That's right. Can you believe we have had no winter? I've never seen that here.
No. Did we
Pretty much went straight from fall to spring.
I think we had one night, maybe 2 nights that it froze.
Right. We have a new employee, just moved to Texas, probably loving the weather, isn't it? It's nice.
A little colder. Didn't he come from Florida?
That's right. It's a little freezing over here.
It's kind of cold here.
No, but it's been very nice. I remember it was just, a year or two ago in Prosper, I had like 14 inches of ice up against my my garage.
We're good for a freeze and some ice at least once in a year, but I hadn't seen it.
I was out there with a giant pickaxe trying to get ice off my driveway so I could get my car out of the garage.
You remember your driveway at the lake? It had that big slant.
Oh.
You couldn't park down there if
No.
you knew it was coming, could you?
Whenever it iced up, we had to park on the top of the hill.
Oh, yeah.
Because you'd never get out of that
No.
thing.
Nope.
Every time an older relative would come over, you'd have to drive them down into the garage because they'll fall right down the hill. That driveway was pretty steep.
Yeah.
All right. For those of you new to the show, we developed this show a long time ago to answer your financial questions. Our philosophy on investing is a little different than others. Typically, what you'll see is a firm that either does stocks and bonds, or they do just annuities, or they do just life insurance, something like that. We believe that there's a place for pretty much everything, as long as it's a legitimate investment. None of these private investments where somebody can, steal your money and all. I'm talking about legitimate investments.
And you don't overpromise and overdeliver and say all these great things are going to happen on a potential investment.
Right. And I called it the Common Sense Investing Show for one reason. If you really break all investing down to its common sense principles, you can rule out a whole lot of bad investments and keep in something that might be for you and your family. And that's why we try to, at this show, we do differently than others. We'll try to tell you the good, the bad, and the ugly about every kind of investment or investment strategy. We're not saying, hey, this managed program is the greatest program in the world. You have to be in it. You have to do annuities. Well, you don't have to do anything. Annuities might be great for somebody and terrible for someone else. The stock market might be great for someone and terrible for someone else. Bank CDs, well, at these rates, I think they're terrible for everybody. But you know what I mean? If the rates were higher, there's nothing wrong with CDs.
It's, I tell people when they call, I use cars for an analogy. A pickup truck is great, a 4x4 if you've got a ranch, but if you want to go to the racetrack, I'm sure it'd be fun, but it's not appropriate. A Corvette, on the other hand, right, be a lot of fun on the track, but if you had to go out to the ranch and deliver some hay to the cattle or something, you're probably going to get stuck. Both are really nice vehicles, and they have their place.
In our business, in the financial services, financial management business, your number one objective is to adhere to the client's objective. Yet, so many advisors I see out there have their own agenda, and they'll try to jam their agenda into your situation. I'll give you an example. Let's say you told somebody, well, I've saved this much money. I think it's enough, but I can't lose any money from this point. Well, then you need to be in our managed stock program because it's only had losses of, 5% or didn't lose in 2008, some crap like you still have risk in it.
That's
all right. There's still risk in it. The person has just told you they don't want any risk. If you want a riskless type investment, then you have to go to the other types like CDs up to the limits, money markets, fixed annuities up to the limits, all these different things. Not the stock market. But if that's all they do, that's the only kind of advice you're going to get. Conversely, if you're a person, let's say you go to a person that only does annuities, and you tell that person, all right, I'm okay with taking a risk. I'm actually okay. I kind of like technology stocks and stuff like that. And they say, no, why do you want to be in the stock market? That's the casino.
They tell you they don't need income. That's taken
right.
care of. They've got pensions.
They said, you need to be in an annuity. Why wouldn't you do an annuity? That's crazy. You don't want to. That's exactly what you should be in. If you're okay with risk and you have a long time horizon, or you don't need income from your money, there's nothing wrong with the stock market. And so we're one of the few advisors that is licensed and qualified to do every type of investment. So we can take your situation, analyze it, and see different appropriate strategies for your particular situation, because everybody's different.
And the problem, if I may, both sides of the coin, when someone's trying to market to you, and they're always trying to market, they stretch. The guy that wants you to go in the stock market tries to give you some statistics of what it's done over the last 10.
Monte Carlo simulations, rolling 10-year periods.
Charts and graphs, and tells you how safe it is.
Right.
The guy that only does the annuities, and you're telling him, you want a good return and you like the market. Well, he's saying, well, it will participate in the S&P 500, and they paint these big, well, you could make 15, 16% on this, and you can't. So they stretch both sides. So again, common sense, you got to kind of ferret through all that.
Right. And that's why we say, of course, all the listeners should only go to us for financial advice.
Well, yeah,
we should be the only ones managing money, of course.
That's understood.
But if you have someone else, you had to. Let's say you just couldn't make it to our office. You didn't, your legs are broken or something. Then definitely go to someone else that is fully licensed and qualified and offers all investment products. If you do not, it's going to be very difficult to get unbiased advice.
And somebody, you sit down and it's a gut reaction. You've got to talk with them. You're kind of interviewing them. They're probably interviewing you as well. And you want to have the same philosophy, because if their philosophy is different than yours, your portfolio is going to drift in their direction.
Oh, yeah.
So you want to make sure that you both or you share his philosophy, but that you have that commonality.
And everybody in this business has been in it for more than a few days is pretty good at this. Their pitch or their presentation, whichever one you call it, is going to be pretty decent. I promise you, when they start throwing out all the Greek letters for how their program is done, look at the beta, look at the standard deviation, the alpha of this mutual fund is amazing. They start throwing out that stuff, it's going to sound impressive. But if you don't want to take risk, quit listening. All right? If you want to take risk, it's okay, but definitely ferret them out to make sure that another type of investment strategy wasn't appropriate. That's why at Dillon Gage we offer both, or every type of strategy. Somebody told me, well, I see the annuity strategy you gave is giving me a little higher income, but I'd rather do dividend-paying stocks. Well, absolutely you can do dividend-paying stocks. You could do bonds with it. All it's going to take is about twice as much money, because they're paying this right now.
That's right.
And
they just came down.
Yeah, I mean, I like the S&P Aristocrats Index, which is the top, 40 dividend-paying companies that has increased dividends 25 years in a row. Pretty good. They still have lost a lot of money sometimes.
Oh, yeah.
You just got to remember, just because somebody's paying a steady dividend doesn't mean you can't lose your shirt. The average of those kind of funds lost about 40% in 2008. So they still can, but if you're okay with that potential loss, that's a pretty good investment. And that's what we have to do is we're giving you honest answers. We're the only ones that don't try to shade highlight the good stuff and lowlight the bad stuff. We're going to show you everything, because there is no perfect investment. The next time I see a 1-year CD, not even a 1-year CD, let's say a money market that's fully guaranteed, that's paying me 20% a year or 10% a year, that's a perfect investment. But they haven't. I think the last time we saw those was about 1980.
It's amazing how many people want that high rate of return. They want everything fully guaranteed. And we were talking about it earlier, there's just a lot of advertising out there. Everyone's coming after your money, especially your retirement money, because that's where you've got the most money stored up. Whether you're clicking around on the internet, whether you're watching CNBC, Squawk Box on TV, it's a lot like the political debates that we're in right now, right? A lot of promises. I'm going to repeal Obamacare. I'm going to build a wall. I'm going to do this. And how much of that actually happens when you sit down? A lot of promises, a lot of potential.
Yeah. You got to be honest with yourself. Like I said, if you're thinking about stocks or annuities or whatever, you have to be honest with yourself. And this is a hard thing. I've been doing this almost 30 years, being got both. But it's hard to be honest with yourself sometimes. I'll give you an example. Sometimes you'll ask a person, all right, what kind of returns do you expect? Well, 10, 12%, of course. All right. What's the worst thing that can happen to you? Well, losing $1. I don't want to lose $1.
Don't want it to go down.
So truthfully, that's not a risk tolerant person. That is a person that's just very safe, right? Not risk tolerant, but wants better returns. But there's a disconnect there. Some people say, well, I'm a little bit behind. I had kids going to college. I really didn't start saving till I'm 50, which is pretty common. And so I need to get real aggressive to catch up. When in truth, that person can't afford the aggression. In other words, if the market lost half of their life savings, they'd be set back too far in a lot of cases if they want to retire at a normal age or whatever. That kind of person, in other words, might be somebody that really needs to take care of their money. Now, let's say I've got $10 million and I'm spending $50,000 a year. You can afford to be risk tolerant. So there's a lot of factors that go into determining what kind of strategy might be best for you. And that's why at Dillon Gage, it's a process that we go through. It's not just hey, here's your sales pitch. It's a whole process to determine what's really best in your best interest, and then we give you several strategies to think about. And I do mean think about. If you have any questions, I'd like to take advantage of our retirement analyzer, Social Security optimizer, don't hesitate to call our hotline 972-715-2424. You can go to ilovemyretirement.com. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, we offer a complimentary, no obligation retirement analysis, retirement stress test, Social Security optimization program. We'll also give a detailed look at your portfolio to make sure you're not paying too many fees, all that kind of stuff. If you'd like to take advantage of that, don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424. You can email me at victor@victormcclure.com or go to our website, ilovemyretirement.com. All right,
Vic,
Guy, you're about to say something.
Yeah, before we went to break, we were talking about all the advertising that's out there. You just get inundated with it. Everyone's trying to get you to invest their funds with them. And there's one example I wanted to kind of bring up. I'm not going to mention any names, but I'm sure our listeners, yeah, you have in the past quite a bit. I'm sure our listeners, you'll know who it is. You've either clicked on their ads, seen the television commercials, but I just want to give you a for instance, because education, reputation, marketing, all of that stuff, if you throw out the common sense, really doesn't matter. You've got to apply common sense to all of this stuff. All right, the advertising, if you click through, this person claims that he has predicted nearly every major economic trend over the past 30 years. Now, is that a red flag?
Yeah.
It should be a red flag, but sometimes it gets intoxicating. Well, this guy's really good. I should listen to him. So you click through and you go to his video, which is long and painful, but I'll just give you the crux of it. After he's telling you how good he is and he's predicted everything, he's predicting that the Dow will hit 6,000 this year. Now, keep in mind, right now it's almost at 17,000. Yeah, a correction might be, 20 or 30 points, but it's a scary thing. He's predicting it's going to go from 17 down to 6,000. So I clicked around on the internet to read some reviews on this person and someone that's done their homework, and here's some of his past predictions. Now, he didn't mention these. He mentioned that what did we say? Nearly every major economic trend over the last 30 years he's predicted. Well, here's what he's predicted. He predicted that in the second half of 2013 that the S&P would drop 30 to 50%. That was only 2 years ago.
Yep, I think it went up in 2013, pretty sure.
Didn't work. Oh, here's a good one. In 2006, the Dow would hit 40,000. And by 2010, along with a great boom that would run from 2007 to 2010.
Well, a client sent me something that said the dollar's about to be worthless. All of the commerce, all of the ships in the world are now at piers. They're not moving. They're not moving.
The oceans are clear.
Moving. Absolutely.
All
I was like, you're kidding, right? And they showed a satellite shot of all these ships and just sitting.
Oh, yeah.
I go, it's a picture. It's not going to move in a picture.
All right.
I go, that is the most ridiculous thing I've ever heard in my life, that all the ships in the world. But this stuff sounds good. Remember, what did I tell you? If anybody could predict the market, what would you have? Me, We talked about this many times. I'd be in Tahiti on one of my many yachts.
That's right.
Native girls feeding me grapes with a fan, because that's my deal, right? And I'd be fishing, because I'm a big fisherman. I'd be fishing off the side, but somebody else has got to pull that in while I'll just take the picture at the end,
That's
because
right.
I'm too rich to actually touch the rod, right?
Don't need to touch the rod.
But that's ridiculous. Nobody's ever predicted everything. They wouldn't be calling you or putting an ad out there because they'd be rich, and why would they let you in on this secret? Just to help you out? No.
And
they want to sell you something.
And remember, when you see these things, it's usually a smart person, an attractive person. They're intelligent. This particular person.
Thank you, guy.
You're welcome. Has been praised for being very smart. So intelligence alone does not guarantee accurate predictions in the stock market. There's, what we would talk about, the Harvard Endowment.
Oh, yeah.
Thousands of the sharpest minds in the world manage that. And what do they average?
Oh, yeah. I don't even remember. It's not much.
No, years
6,
ago.
7%, maybe.
Yeah, or maybe even 9 or 10
But you
even.
think about that. Everybody tells me they've developed a new system that'll beat the market. I hear this all the time. No, this one predicted this and predicted that, and oh, wait, I did this, blah, blah, blah. Oh, wait, it's almost 10 years ago. I don't know why people keep saying that, but they keep doing it. All right? Think about this. You know how many thesis papers some of the smartest minds in the world have tried to figure it out? They've got research departments at the best colleges in the world trying to figure out some kind of consistencies in the market so they can take advantage of it. Not one in history has ever figured it out. Yet,
Exactly.
someone trying to sell you something has magically figured it out.
That's
Some
right.
sales guy that has a good voice has figured it out somehow that the smart Einstein couldn't figure it out. No, because it can't be. It's too random.
Now, we don't want to be hypocritical. At Dillon Gage, we do quite a bit of advertising. It's the easiest way to talk to new people. But I want to make clear, when we do and you hear our stuff, we talk about absolutes. And that's why you hear our advertising is about fixed annuities, because we can give you real figures. It's a guaranteed, not a potential type of investment. We can talk about our customer service because we know it's number one. So we try to talk about things that are absolute and golden. And if you have any questions or if you'd like to sit down, 972-715-2424.
Yep, again, 972-715-2424. ILoveMyRetirement.com is our website. It has a bunch of videos on there, like our thoughts on stocks, our thoughts on bonds, our thoughts on annuities, on retirement planning, on financial planning, all those different kind of things. You can look at some videos and get a little sense of who we are. And like I said, we've been doing this a long time. Neither one of us ever had a single complaint, which is pretty strong in this business. Trust me, when you deal on stocks and bonds, there's going to be somebody mad from time to time.
Whether you're right or wrong.
That's right. But don't hesitate to call us if you'd like to take advantage of any of our complimentary programs, 972-715-2424. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we were talking about what to look out for in advertisements, false advertisements. Remember, nobody can predict the market. If they even have one simple delusion that they figured out once, run.
Yeah, and the problem is they're marketing, and they've got this stuff packaged nicely, depending on how much they've spent with their advertising firm. And there's a few things that we'd like to share with you that you can kind of draw from all of this, or at least be armed with. One, great research. And they tell you we've researched it and the whole thing. Great research does not mean that you can beat the market. Anyone, any guru, anyone like Victor said, who claims to be smarter than the market should not be trusted. And that's the best way to put it. No matter how logical it sounds, and it always sounds logical.
Oh, absolutely.
Number two, in today's market, probably more than ever before in history, recent and past performance does not indicate future performance. In fact, we've got to type that disclaimer on everything that we do. But think about it. A money manager or a fund can thrive for a year, for 5 years, or for 10 years, and then plummet.
Yep.
It's because the market shows it something it hasn't seen before. You've heard Victor and I talk about many a times, all of the greatest programs in the world, or most of them, have been back tested. They have a set of criteria that they've gotten through research. They try it back 5 years, 10 years, 15 years, it works. They go back 20 years, it doesn't. So they've got to redo everything, and they keep doing it till it goes back to the infancy of the stock market. It's always worked, and they've got their program. And it works for a while, usually, until the market shows it something it hasn't shown before. Kind of like our election cycle right now. Something we've never seen before, but I digress.
Yes, we've never seen this before, for sure.
No doubt. And third, it's along the same line. Charts and graphs can be found to say just about anything you want them to. And you've seen it 100 times. You can skew the numbers to highlight your area. They are useful, and they're used a lot of times to draw correlations between economic performance and demographic trends. But those two don't always intersect. So no matter how many charts and graphs are used, it's not the magic bullet.
I'm not a big chart guy, technical analysis guy.
No, but you want to be informed, right? And information is empowering, but it's not an absolute, and it's not positive. In this business, it seems that those that can do, whereas those that can't tell you they have some sort of magic bullet, or they have a tremendous marketing system around it, and it looks good, and I know it's tempting, but just be careful.
No, it's the charts just seem like you can go back and look at charts for the last 100 years. And what they do is they go back and see these charts ups and downs. And if I'd have just got out here, if I'd have got in here, and oh, look, I saw this again. I saw it again 10 years later. I saw it again. It never works long term. There's never been a technical analysis, based program that has worked long term. Now, don't get me wrong. If you do fundamentals and technicals together to kind of spot trends, it can be helpful. It can help you rather than just going naked or blind to the market. But it's not, there's no magic bullet. Trust me, there's never been a magic bullet.
We had a guy here that had a managed futures program that was just, he did great.
25 years, beat the market or something?
I think he did like 100% a year for 4 or 5 years, but it was mechanical.
Right.
It had 3 positions, a long, medium, and short term for each position that he had in the market. They would all act independently of each other. You could be net long, net short, and they would move. And it worked he only had like 20% of your money in the market at one time, so you could lose it and still come back 4 times. It was outstanding until
it quit working.
Until it quit working.
I remember the traders that were in this office, 10, 15 years ago?
Yeah.
They had some deal that said diversification.
That's
you
right.
should only have like 3 stocks.
That's right.
And it worked great because they were all technology stocks until they crashed. And
that's
I don't
exactly
believe in
what
it.
happened.
Absolutely. I don't believe, like I said, this is the common sense investing show. It's not the common BS show.
And that's what you get from experience. People have been through this.
That reminds me of something, guy. Do you realize the smartest people in Dallas are our clients? Oh, I can't say that.
I would agree.
Is that too much?
I would agree.
All right, I disavow.
No argument there.
A la Trump. I said something outrageous. I'm disavowing it. Please don't hold that against me. Remember, our philosophy on investing is something that is a little different than a lot of other advisors out there. We believe whatever your bills are, let's say you're spending $10,000 a month. If you have $10,000 a month, if you can afford it, well, then buy $10,000 a month. In other words, I want a retirement paycheck. So as soon the day I retire, I still want money coming into my bank account that is over my bills, and I'll never worry about the stock market or interest rates again. That is a departure from a lot of them that tell you stocks are the only way. Remember, Ken Fisher says a 50-50 portfolio has a 70% chance of success.
And we've got some new fixed annuities now that will increase for inflation each year, which are really cool.
Yeah, the only reason we use annuities, the only thing guaranteed for life, and it pays about double what everything else is paying.
But how about if you got a raise every year with it?
Oh, absolutely. We'll talk about that more after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Just like I said, it's common sense. Does it make sense to risk everything you have on what the stock market will or might not do? I love the stock market. I've been managing people's money in it for a long time. I've been in it for a long time. I'm in it now. Remember I told you I was out? I got a quarter back in now. Still not convinced.
I got half in, but I'm nervous.
Oh, you went half.
I did.
Ooh, you got nerves, right? No, I'm like, still doesn't look good right now. But there's nothing wrong with the stock market, but I do want to do the stock market after the bills are paid. And if you can do it, the earlier you can set that program in place. Like if you can set it in 5 or 10 years before retirement, you can put in a fourth or a fifth amount as much money. Or you can wait. Remember, you don't have to do the guaranteed annuity option. You can do stocks or bonds. You just need more money. At these interest rates, you need to put in 5 times more money to get the same kind of yield, or 2 times more money, whatever it is. So we can give you the guaranteed option or the non-guaranteed option for retirement. It is entirely up to you. We can determine if anything like that is even necessary for your portfolio. Okay? Some people just, it doesn't make sense to carve out a piece of what they've got and create an income stream from it. To me, it makes a lot of sense. If I know I've got, $2 million and I can take $500,000 and guarantee that I will never run out till I die, even with inflation, that's attractive to me. So I want to look at that option. Some other people say, nope, don't care. It's always been good for me for 30 years. It'll be good for me the next 30. I'm not that much of a gambler.
Yeah, that's one of the things we do, and that's our philosophy. I had a client and become a good friend in last week. One of the other things that we do that's helpful, diversification is good, but also help folks clean up their stuff. I had a client in last week that had a little bit of money in a variable annuity he didn't need, but the fees were high. So we were able to purge that for him and put it in his cash account, his stock account, which is also his cash and working management account. He had a couple paid up life insurance policies that were fairly substantial. Didn't need the life insurance, but the life insurance policy was paying a dividend of a little over 5%. He's still working.
It's not bad.
Probably going to work for another year or so. So if he was to cash it out, he's taxable over his basis, what he's put into the life insurance. So right now it would guarantee it gets taxed at the highest rate. So we keep it. It's got a good rate. The rate's going down every year. When he retires in a year or two, we've got that earmarked to be sold. It goes into his working capital, his cash, his stock account, and cleans it up. But we're not going to do it till he retires. Why? Because it's going to trigger a taxable event. Now it'll be at a lower rate. Individual also had a couple of condos, served him well, been paid for a long time at cash flow, but you got homeowners associations to deal with, leaky roofs. You've got to get them to repair. Wants to travel now. So we're going to clean those up. We get those when the time is right, hopefully this year sometime. We'll get those on the market. The market's hot. Get it cleaned up. Where are we going to put that cash? It's going to go in his working account. It's going to go in the stock account. It's going to go in the cash account. Also put 7 figures, a good 7 figures in fixed annuities. With that, his pension, the Social Security for him and his wife, the amount of money that it's going to provide, it exceeds what they needed for income for the rest of their life, that they'll be able to do what they want to do. It frees up the burden on all the other money, but yet he's got the working capital reserve and the whole thing. So other than taking care of the income, we do the stocks, but also we help keep you diversified, but get things cleaned up. All of us have a lot of little stuff out there that you probably can just get cleaned up.
And just remember, somebody asked you, what's the difference between a salesman and advisor? There's sales in every part of every business there is, no question.
Absolutely.
A lot of difference is if you see a guy that brings let's say an annuity to you or something with a penalty on it, and they immediately say, well, let's just cash that out.
Yeah.
That's the first thing they say. They haven't even looked at the thing.
We're going to put you in another
annuity. We're going to put you in another one.
Yeah.
That's a big red flag that this person is just a salesman and they're going to tell you anything. Disregard most of the advice. Now, if it's one that's losing its butt and you're paying real high fees, and that's one they talk about how you could move, but if they usually attack it, especially if that's a large part of your assets, you might have a pretty good one already. Oh no, this new one's got better. The rates on your old one was probably better. Trust me.
And if you have surrender charges of 4 or 5 or 6%, don't worry about that. This one has a bonus of 4 or 5. So it'll sound good to you, and they'll have a way to explain it.
Paying a penalty should be your last resort. Don't get me wrong. Sometimes it's still necessary.
Absolutely.
But it should be the last resort, not the first thing somebody's looking at just because it's a large part of your portfolio. Remember, let's say you've got a portfolio and you have a few questions and just like a second opinion, don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
All of these things that we're talking about are products of our financial analyzer. The client I talked about, some of the things you talk about, we put the information in there, your Social Security amount, what you're going to get, your pensions, how much income you need, where your stuff is. That points us in the right direction. and it'll identify some problem areas and some things, and we're happy to do that.
A lot of people don't realize that their cost of living adjustments, unless you're already retired,
Right?
but the cost of living adjustments on Social Security. If you're 55 right now, when you're 85, Social Security is going to be a lot higher than you think. Now, it won't buy as much.
No, that's right. It needs
Inflation hits on all ends, but you need to kind of know that to really plan. I want to know what my life is going to be at 80 with a proper plan. I'm not going to wing it. I'm not going to shoot from the hip, because what if you can't? Your thought, your cognitive resources. I'm trying to how to say this right. might not be as acute.
There you go.
When you become a certain age, you can take care of that now while everything there. Don't hesitate. Like I said, call us and we'll be more than happy to go over your stuff. And there's never an obligation. There's never any cost. It's always complimentary. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Now, we developed this show to answer your financial questions. A client came to me, it was actually a listener, came to me last week and said, I'll tell you what, there might be 5 minutes to 10 minutes of almost every financial show where they're actually teaching you something. I learned something from yours most of the show. I was like, well, thank you.
Good.
That's what I tried to do.
That's
but
good news.
It's not as good of a salesy show like we're always trying to pitch something, but I think it really helps people. And we're going to go over your questions after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. It's our last segment, so I want to make sure we get a few questions in. These are questions from our listeners, our clients, prospects. Anytime I find one that I think will appeal to a broad audience, I'm going to share it with you. If you have any financial questions, don't hesitate, 972-715-2424. Okay, Guy, what's in the first question?
All right, this is an oldie but goodie. I know you like indexed annuities and don't like variable annuities. Are all variable annuities bad?
Yes. No.
Well, the
Yes.
key word is all,
No,
right?
Right. Of course, nothing. There's never a whole group is bad. The reason why variable annuities get a bad rap, and it's justifiable, right?
Yep.
Is because some of the fees with the riders can get up to 4 or 5% a year. Now, anybody pays me 4 or 5% a year is my number one client. You're not going to be a happy client.
No.
Right? So that's why I cannot recommend anything with high fees. There are some variable annuities like TIAA CREF, Vanguard. They're stripped down. They don't guarantee anything. They just give you tax deferred and judgment proof on mutual funds. But those are
Which are the two reasons you'd consider them?
They're pretty good because you can, you might could get away with a 0.5% or less in fees. See, tax deferred is worth something. It's just not worth 4 or 5% a year. But a 0.5% a year, sure. Especially, let's say you're a doctor and you don't want to get sued for the money. Well, annuities are judgment proof in Texas, so therefore, that's not a bad option. So index annuities, not all index annuities are good either, by the way. There's 144 of them. There's probably 10 of them on the good list. And the good list is I want to pay a lot, I want to be high rated, and I've been in business for a long time.
Yeah, and there's a lot. There's several moving parts, not too many, 4 or 5, but you could be looking at something solid with an A+ rated company on the index side,
right,
that pays 6 or 7% guaranteed, and someone that doesn't have your best interest in mind will say, "Oh, you don't want that. I've got something that pays 8 or 9% a year." Well, they may not be telling you it's simple interest. It's not compounded interest, or the payment that you would actually get when you retire is lower. So you have to, there's more to it than just rate of return and amount that you deposit.
That's right. Oh, what's the next question, Guy?
All right. I hear you radio guys all the time say that the market hasn't done that well and that you have to have an advisor to protect you, blah, blah, blah. I've made 12% per year on my portfolio over the last 15 years. Wow, that's a big number. Why don't you explain to your audience that with a little bit of research and time, that anyone can do fine in the market without an advisor? Ooh, that sounds like an angry one. Is that one of your angry
Like,
letters?
Where'd
We
that
get
come?
those every now and
Came
again.
from a
don't
Trump
we?
rally or something?
Yeah,
Gosh, sorry.
Anti-establishment.
All right. Obviously, you can always manage your own money. We've talked about this many times. If you have the time, the expertise, and the risk tolerance, there is absolutely nothing. And what I recommend for somebody managing their own money is index funds, ETFs. Go the lowest cost you can. Individual stocks are fine, except individual stocks, if you're not diversified enough, and having 10 individual stocks, trust me, is not diversified. All right.
Right.
You can't be diversified enough. So I really go with index type funds instead. But what people do is they compartmentalize stuff, because there is no way somebody's portfolio made 12% a year the last 15 years when the market made 4%. When we know 90% of people never beat the market, you didn't triple it.
Give them an idea what 12% over 15 years. Give them a number.
Yeah, let's say you had $1 million. Well, it's $5.5 million just that one account in 15 years. That's what 12% a year is. Because what you'll find, I had a person tell me that. No, I've made minimum 8, probably 13, 14. I said, show me a statement from 10 years ago. And if that, because he had about $2 million.
Yep.
All right. If that thing had 250,000 and you didn't add a penny to it, then I believe you. They go, well, no, it had like $1 million. I go, $1 million to $2 million over 15 years is about 2% a year, 2 or 3. It's not anywhere close to 12 or 15, but people compartmentalize things. Though what they do is they'll take their wins and in other words, that was my whole deal. We won on everything. And their losses, they kind of put that off to the side. It's psychological. Everybody does it. You don't want pain, so you put the pain away. The good stuff, you'll fixate on it. Look at me. I made 25% on that stock. The last one I made 10 on, you forgot the one you lost 30 on. Throw that out. And you're like, I must have made 15% a year.
Or you're adding money, right?
Yeah, you got to be realistic with all of those kind of things. Like I said, that's what it takes to make 12% a year. Or let's say you made 7% a year. Over 20 years, that's 4 times your money.
And the problem is, to get 12% on your portfolio, you really had to make probably 20% because you've got some money protected in bonds or CDs or cash. So it's a big number.
Well, I've had people with 50-50 portfolios that said they made 15% a year. I'm like, really? You're getting 1 on the money market, maybe 2 or 3 on the bonds. So what did you make? 40 on the stocks? Really?
A big number.
But, hey, that's what it is. But you can manage your own money, but be realistic with it. This is called the Common Sense Show. Remember, it's not the Common BS Show. You want to make good returns on the market. If you're taking the risk, you better be getting rewarded for it. Right now, the only problem is the market's made 4% for the last 15 years. You're not getting rewarded enough for it, in my opinion. But what's your next question?
All right. I have a mentor who is a successful business owner. I showed him an investment plan from my financial advisor, and he recommended that I discard their plan and just invest similarly to how he invests. He explained that you don't need to pay fees and that my advisor doesn't know any more than anyone else. I'd like your take.
Okay, we don't have much problem. We have to go into that next week. But your friend might be a very successful business person. They might not be in the same situation as you. They might not be the same age as you. They might not have as much money as you, which is 90% of the time. So somebody that has a lot more money can take a lot more risk. You might not be able to. But we'll talk about that more next week. I want to thank everybody for listening to the Common Sense Investing Show today. Remember, if you have any financial questions, like to take advantage of our complimentary retirement stress test, retirement analyzer, and Social Security optimizer, our number is 972-715-2424. Again, 972-715-2424. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.